Importance of financial planning, I cannot really stress upon too much, because all of us are aware that everybody wants to be financially independent sooner than later. Investors are looking for guidance on when and how they can start to use their own funds during their lifetime and become financially independent sooner than later. The unfortunate part is we've been only speaking about how they should be creating wealth through their life, and then using that for the benefit of during their retirement period, or what we call the distribution phase. But I beg to differ there, because according to me, why can't this money be used by the investors during their accumulation phase also? I will speak about different phases of the investor and how this is being used only during the distribution phase, and why should it be used during accumulation phase as an effective tool for them to manage their cash flows. Retirement is not equal to financial freedom, or it need not be equal to financial freedom, if the investors have not managed their money during their own 30 years of their professional life, what we call rule of 30-30. Rule of 30-30 says you have 30 years of your professional life and 30 years of your retirement life. If we have not managed our investments wisely during those 30 years of your professional life, then retirement need not be equal to financial freedom, but financial freedom can help in retiring. Once you are financially independent, even at the age of 40 or 45 or 50 or 55 also, it need not be just at the age of 60 plus, the way retirement is being perceived, then one can actually be financially independent and retire, and maybe do other activities, their passions, playing golf, learning to play guitar, piano, whatever one might be the passion of the investors. They are free at that point in time to pursue their hobbies also, if you are financially independent. This is possible only when you create a second source of income, and Warren Buffett has said this: never depend on a single source of income, make investment to create a second source of income. We have always spoken about this. We have guided our investors to create second source of income, but how to use that second source of income, and when should they start using that second source of income to create their own wealth, is what we will discuss today through fixed amount benefit, that FAB, which Motilal Oswal has coined it very appropriately. These are the different phases of life of investors. First is the planning phase, which lasts about 4 to 5 years. Then the accumulation phase, when you start saving and investing. Then the distribution phase, when you want to retire and you want to start enjoying the fruits of your hard-earned work which you have done over a period of time during that accumulation phase. And then finally the legacy phase, when you want to leave behind what you have created for the beneficiaries, which means your kids and your grandkids and so on and so forth. But have you given a thought that why are we guiding our investors only to do wealth distribution during only distribution phase and not during accumulation phase? Why can't I do distribution of my own wealth during accumulation phase? What is that second source of income? The second source of income is nothing but creating a fixed amount benefit from your accumulated wealth and created wealth which you've done over a period of time during that accumulation phase. So the accumulation phase can be from 25 years to 45 years of age, when you would have slowly and steadily started saving, your income has grown, so you started doing step up of your SIPs and your investments and created wealth for yourself. At the age of 40-45, must be wealthy enough for you to start withdrawing some money to enjoy the fruits of your labor during your accumulation phase. This is what I had tweeted: SIP is overrated, SWP is underrated. Finally, investors invest with a view to get regular cash flows. Nothing better than SWP, tax efficient way to generate regular cash flows. When I tweeted this some time back, it had garnered almost now 30,000 views and almost 200 plus likes on this particular tweet. And a lot of queries and questions had been asked on that particular tweet as to what is SWP, how should we use it effectively, etc. Motilal Oswal, as I said, has come up with this FAB plan, fixed amount benefit plan, income B, wealth B. You will create income for yourself also, and you will start accumulating and creating wealth for yourself also simultaneously. And how do we do that, and how do we achieve that? First and foremost, how is second source of income created? When we save from primary income, which is either salary or business income, invest that money, and then it creates a investment income. So a saving from your salary or your business income, investing that money, and then generates a second source of income through your investment income. Now, can we depend on investment income for regular cash flows, is what I'm going to answer as a question. Investment income can be interest on fixed deposits, it can be interest on debt instruments, and so on and so forth. But income from debt may not be able to beat inflation. Income from investments through dividends, dividend can be only declared out of realized gains in the mutual fund space, or as and when the companies declare dividends, which is a yearly phenomena as far as the investors are concerned, those who invest directly into stocks, etc. Again, you cannot depend on them on a regular basis unless and until there is profits, there is realized gains. At least the mutual fund industry will not be able to generate that regular income through dividends. And finally, capital gains can only arise through either the markets have gone up in the equity markets parlance, or interest rates have gone down, and you have invested in debt as an instrument and you have created capital gains. So these are the sources of income through investments, but they cannot be relied upon for generating regular cash flow. Then what is the solution? Interest income or dividend or fixed amount benefit from your own investments. Aspirational lifestyle of the youngsters. So you are spending a lot of money on EMIs, salary of your staff, vacation, insurance, your regular expenses on your vehicles, petrol, dining out, pubbing, etc., and also saving to invest through the mutual fund route or directly also. Now, the aspirational lifestyle of youngsters have gone up dramatically, and that's the reason why they start borrowing for anything and everything. They have started borrowing. Pay now, buy now and pay later is a phenomena when it comes to buying a phone, when it comes to buying a car, buying a house, or even nowadays there are startups which are saying that your wedding destination weddings we will finance. So anything and everything there is buy now pay later. The unfortunate part is that the limited income of the investors get blocked, and we are getting into that Western culture of consumerism and living from paycheck to paycheck. By the time the next paycheck comes into your account, all that money is already spent on different EMIs. Now, what you as a mutual fund distributor can do as a value add for your investors is create a survey. What should the survey include? Send a survey asking questions on the recurring expenses like EMI on house, car, insurance premiums, utility bills, shopping, etc. As MFDs, you already have the portfolio values. If you're an advisor to your investors, you exactly know where do their investments stand and what kind of portfolios they have generated. Proactively suggest that FAB, fixed amount benefit amount, they can create from their own portfolios. They are not aware of it because we've never guided them on creating a second source of income through the existing portfolio which they have created. So all we have to do is give them, show them, ask them to create an Excel sheet, put their expenses in perspective or for anything and everything which they would be spending on. It will be something like this. A monthly average expenses on different heads, which will be a minimum on the minimum side and on the maximum side or even higher than this also sometimes, if you are in a super HNI category. Housing, rent, mortgage, food, grocery, dining out, transportation, car owners, healthcare, education, entertainment, shopping, staff salary, vacations, investments, etc. If you notice, approximately 50,000 rupees on the minimum side and about 1,25,000 rupees on the higher side is what the general expense heads would be for most of the households. Once they have done this exercise, then you can go back on the drawing board, work on their portfolios, and figure out what kind of wealth they have created and what kind of fixed amount benefit can they generate from their own investments, and mitigate these expenses so that they are mentally free, relaxed, stress free, and they will be able to manage their income and expenditure better. They are unnecessarily taking borrowings for more and more spending. But why borrow when you have already created wealth for yourself? Simple example, if somebody would have started a 10,000 rupee SIP from the age of 25 to the age of 45, assuming 12% growth in that SIP, and I'm not assuming step up here at all, the 24 lakh rupees saved and invested at 12% could have grown to 1 crore rupee. From there, if we start withdrawing 50,000 rupees, which is 6% per annum, the underlying I'm assuming is still growing at 12%. So there is income B of 50,000 per month, and there is wealth B, because that underlying 1 crore would still be growing at 6% per annum. But if somebody was wise enough and had done SIP, which is a step up SIP of 10% per annum from the age of 25 to the age of 45, 10,000 rupees for the next 20 years, he has saved and invested 68 lakh rupees. That could have grown to 2 crore rupees over a period of 20 years at 12% per annum. Now that 2 crores could have fetched him at 6%, 1,20,000 rupees. So that means if somebody would have started their SIP, they have created wealth for themselves, and from there we start doing a fixed amount benefit or a SWP of 6% per annum. This is on the minimum side of 10,000 rupees, but if you start adding numbers, 25,000 rupee SIP, 50,000 rupee SIP, and so on and so forth, you can imagine where these figures would be and what kind of FAB amounts they can actually withdraw during that accumulation phase also, and mitigate all the expenses which I had shown you of 50,000 rupees to 1,20,000 rupees, and still the underlying is growing at 12%, further 6% per annum, because you're only withdrawing 6% per annum. But do not forget that for the next 20 years, if you would have done SIP and during that period you have not done any SWP from 25 to 45, your base has grown, your money has compounded also, and then when you are starting to withdraw 6% per annum on that higher base, naturally the benefits to the investors would be far better. This is what we call deferred annuity. You start investing, you save that, you let that money grow for some period of time, and then start your SWP or FAB. Naturally the underlying growth will be much better. So what are the benefits of fixed amount benefit? It's assured regular cash flow. You will definitely get that 6% per annum. If you have opted for 6% per annum, you will get 7% per annum if you opted for 7%, and so on and so forth. More tax efficient, and I will explain to you the tax efficiency part also. Step up FAB to beat inflation. The way we are talking about step up SIP to save and invest, there can be step up FAB also. You start withdrawing at 6% now, maybe 2 years or 3 years down the line, if the inflation is hit, you may wish to withdraw at 6.5% or 7%, and so on and so forth. Possibility of wealth creation over and above the fixed amount benefit. So income B, wealth B. Plan your retirement through deferred annuity. Automatic transmission of investments to beneficiaries. If you have invested money in 2 different accounts, let's assume that my parents had invested, my mother had invested in her name first and my name second as a second holder, then her name first and my sister's name second as a second folio. Automatic transmission of units happens if that person is no longer there, and manage your expenses better through a fixed amount benefit which you could have created during your accumulation phase. You do not need to wait till a distribution phase for you to generate the benefits out of your own investments and your wealth creation. This is an actual example. If Motilal Oswal Midcap Fund, you are invested, this is their inception, which was somewhere in February 2014. So let's assume that you invested on 1st of April 2014, 1 crore rupee, and you deferred, let that money grow till 2017. You did not create any SWP or FAB for 3 years, what we call deferred annuity after third year. You started withdrawing from 2017 onwards till 2023 May. You have withdrawn 37 lakh rupees, which is at 6% per annum, 50,000 per month. The current value of Motilal Oswal Midcap would have still grown to 4 crore 21 lakhs in spite of this withdrawal of 37 lakhs. More importantly, on this 37 lakh rupees, you have only ended up paying short term and long term gains tax of 3 lakh 37,000. This has generated an XIRR of 18% because equity as an asset class would have done well over a period of time. Now, the same investment in Motilal Oswal Midcap Fund, but you deferred it instead of 3 years to 5 years. From 2019, you started withdrawing 6% per annum. The 25 lakhs withdrawn from 2019 to 2023, the current value of the scheme would have grown from 4 crore 21 lakhs to 4 crore 45 lakhs. But again, it's tax efficient. You've only ended up paying short term and long term gains tax of 1 lakh 67,000 rupees. Now, at the same time, if we would have done an investment in SBI fixed deposits in April 2014, where the interest rate on 5-year fixed deposit of SBI was 8.5%, not 6%. You had let that grow for 3 years, and thereafter again you did the same SWP or interest. You earned interest at 8.5%, which was 37 lakh rupees. But the current value would have been 1 crore 67 lakhs, but you ended up paying 11 lakh 10,000 rupee as tax, assuming a 30% marginal slab rate of taxation. Same example, fixed deposit of SBI, held it for 5 years and then you started withdrawing money. You ended up paying 7.5 lakh rupee tax versus that 1 lakh 67,000 rupees of tax which we had. And plus, naturally, fixed deposits cannot grow in value. This was only because we let it accumulate for 3 years or 5 years, and that's the way you are seeing higher value than 1 crore rupee, which when we invested in April 2014. So first of all, fixed amount benefit, it is very tax efficient also. It gives you regular cash flow. It can generate a second source of income for the youngsters also, or the middle-aged investors. During their accumulation phase, they need not go to do bank borrowing, etc. They can dip into their own investments, which is still growing at 12% to 15% depending on where they are invested. And you start withdrawing maybe at 6% and then slowly and steadily step up your FAB amounts also, and that will help them manage their cash flows better. Finally, all of us must remember that your kids are not your retirement fund, and the kids should remember that your parents are not your emergency fund. All of us must create our own wealth. This is my website. I'm available on those who wish to follow me on Twitter. I'm Mr. Bond is my Twitter handle. Mutual fund investments are subject to market risk. Read all scheme related documents carefully. Thank you so much. Arpit?
Yeah, thank you so much, sir. I think it had been a wonderful explanation on the entire concept which you had given, and I really like that thing. So SIP are overrated and SWPs are underrated, and it's been the practice throughout because since over 2 decades, when the mutual fund started, everyone is focusing on creating the wealth. No one has ever, or very few people are even thinking of how to use this wealth which is being created by the current generation or the person who is creating the wealth. So thank you so much, participants, for joining in. Have a fabulous journey with the FAB plan of Motilal Oswal AMC. And thank you so much, Sunil Zaveri sir, for your views on this SWP and the FAB plan.
Thank you. Thank you for
Yeah.
inviting me.
Thank you and a very warm good evening to all of you.
Bye
Thank you.
bye.